Appreciate you taking the time to be on the call today. We will continue to do these either weekly or every other week, depending on how information comes out and everything else. I do want you guys to know that I am at least 6 feet away from Joel Faircloth. I wish it was more, but it's not. But what we figured we would do today is, kind of treat this more as a Q&A. So basically, I'll be able to, ask Joel questions and maybe even elaborate on some of the strategies or some of the information that we'll present. So we'll kind of use today as more of an interview type process. And so with that, we'll get going here. So Joel, a couple of things, and we'll start off with, I think, a question that everybody has on their minds that certainly my mom has asked at least a couple of times to me. Why don't we just move to cash?
Yeah, I mean, that's a really good question. And it's complicated, basically. So, one of the things that we often talk about here, and most of you have heard this at some point in your investment careers, either with us or with other people. When you go to cash, there's often a chance of missing potential upside, and we've certainly seen that this week. We personally fielded a few phone calls on Monday when the Dow was around 18,000 that, people wanted to go to cash, and, we explained to them why you didn't do that. And certainly on Tuesday, there was an 11.5% rally in the Dow. That's why we don't. So JP Morgan and BlackRock and even Vanguard has put out some really interesting data on this. And this chart really kind of sums that up. When you have an investment, it's important to stick it through sometimes. I know that's difficult to do when you look on your accounts online or look at your statements. But this example really drives the point home. So this is a hypothetical investment of $10,000 in the S&P 500, starting on January 3rd and ending just on December 31st. So you have to remember, this includes the dot-com bubble, this includes 9/11, this includes 2008. So if you had just stuck it in there and just left it alone for a 20-year period, your average annualized return was about 6.6%. If you had missed just the best 10 days over that period, so let's put some context around that. There was approximately 261 working days in a year, and I'm just using that as a proxy for how many trading days there are. That's 5,220 days. If you just missed the best 10 of those, rather than getting a 6% return, you got roughly 2.5% return. So just a dramatic difference in trying to time markets.
So Joe, can you kind of talk through, and guys, I think we've gotten some comments that the audio is a little bit rough. We'll try to fix that and work on that here on our end. So, kind of be patient with us. Sorry about that. But Joel, if you can kind of talk through, what we're currently doing, and maybe even what we've done to, number one, obviously nobody saw the Corona thing working out like it has. But, we started making changes back in January and even longer and before that. So can you kind of walk through, what basically what we've been doing?
Sure. Last week, Cade kind of talked to this, but we actually put a slide together to basically better illustrate some of those thoughts. So about a year and a half ago, before the fourth quarter of 2018, we sold out of all the risky bonds that we had. And risky bonds, there's a time and a place to own those. But going into the fall of 2018, those prices had just gotten to the point where they were no longer attractive. And really, this kind of goes back to a lot of the things that we've talked about before, that we're not market timers, but we are tactical and we're data driven. So when we looked at the high yield bond space back in August of 2018, and we looked at the valuations there, they were nearly historically rich. So that would basically like buying .com stocks in April of 2000. It's just something that you just don't do. So we made that decision to sell those out there. As we kind of rolled through the fall of 2018, we did start to have more of a domestic tilt to our portfolios. And then we had that big sell-off in the fourth quarter. So if you remember back in 2018, there were really two sell-offs. There was one in October, that was about 10%. The market kind of moved sideways in November and then had another big sell-off in December. And I remember reading the headlines on Christmas Day, actually, that it was the worst Christmas Eve trading day ever. And then sure enough, December 26th was the best day after Christmas ever in terms of trading. And we were buying into that. So when we talk about this December 2018 rebalance, we were buying stocks there. The economic data told us that. There was no sign of a recession at that point. I mean, the stock market had sold off 20% and it was cheap in our opinion. And that worked out there. As that rebounded, it rebounded extremely quickly. And then we started to see price dislocations the other way. So as things went through 2019, as you remember, it was a 30% plus year in the S&P 500. We were trimming profits along the way there for a good chunk of the year because the stocks had just gotten too far too fast the other way. So having this type of volatility is somewhat normal, but again, trying to keep portfolios in line and maintain the risk is important exactly because of what we've seen in the last 6 weeks. So coming into 2020, everyone has heard me say and hopefully has read the commentary and hopefully reread the commentary from back in 2019, 2020, defend and diversify. Coming into the year, we looked at stocks again, and we were happy that portfolios were up a lot in 2019, but looking at the valuations again, they were just too expensive. So we didn't go run and hide. We basically made for example, a 60-40 portfolio that's supposed to have 60% stocks and 40% bonds. We made sure that it looked like 60-40. We also added some more defensive measures in there at that time. So the 60% in stocks can be a variety of things. It can be all dividend payers. It can be all tech stocks. It can be real estate. It can be a lot of different things. So we really kind of ratcheted down some of the things that had gotten really, really high in terms of valuations and really spread out the diversification in there. Now, since then, obviously, we've gotten a ton of new data just since February with the coronavirus, China shutting down. Then we had the oil price war, which is still ongoing. So what we've started to do back in February, as more and more news started to break out, the first step was to trim some of the international stuff. That was where markets were being most directly affected at that time. And then starting in March, early in March, we actually started to add a hedge to the portfolios. So we've been kind of dollar cost averaging that hedge into position, and we're happy with where it's at now. The recent market rally, it has been fascinating to watch. Tuesday was not out of the norm in terms of some of the things we expect. I have some more slides coming up on that in terms of the recent market action and kind of what we expect going forward. But Andy, that's a really good kind of summary of what we've done up to this point.
Okay, Joe, the other thing too is, can you kind of talk to, I mean, obviously some of the data that we're seeing, I mean, we talk a lot about the investment thesis, and, when we apply data to the portfolio decisions. Can you kind of talk a little bit about, I know there's a lot of unknowns right now. There's a lot of speculation on, where we are in the economy, and basically the overall effect that this is having on our economy right now.
Yeah, for a while, internally in our investment committee meetings, and I've tried to make this point across in a lot of our client meetings as well, we essentially need visibility on three things. The first one is monetary stimulus. So whenever you hear the word monetary for everyone on the call, that specifically usually refers to central banks. Here it's the Federal Reserve, and they stepped up to the plate significantly so. So back in 2008, they had all kinds of different names for stuff, TALF, TARP, a randomness and an assortment of acronyms to kind of go through, so I won't bore you with all of them. But it was basically called quantitative easing, or QE. So essentially, the Fed ran out of rate cuts, which has been historically the go-to to help get us through recessions. But once rates go to zero, there's only so much more they can do there. The Fed has currently said they are not going to cut rates to zero. Or negative. We do have negative yielding bonds in the market now for the first time. So we have negative rates, but that's not Fed policy. That's more market action driving that. So basically, the first leg of the three-legged stool, so to speak, was we needed clarity from what the Fed was going to do, and we got that in a huge, huge way. Basically, they have promised to purchase anywhere from $4 to $5 trillion worth of assets. That's trillion dollars. That is a massive influx of liquidity into the system. So why is liquidity important? We saw some really disturbing movements in the bond markets and money markets a week to 10 days ago, where high quality assets were selling. In fact, if anyone was looking to refinance a mortgage in the last 10 days, you may have been surprised that mortgage rates actually went up, not down. So mortgage rates went up because there was a lack of liquidity. So what the banks do in that case, it's a basic supply and demand function, is what humans have done for 10,000 years. Things that are in limited supply, the price goes up, and that's what happened to mortgages. Mortgage rates actually went up briefly for a while there because there was a liquidity squeeze. So the Fed started to go in, and the first thing they did was buy, or at least inject liquidity into money markets. That was really the first step. That's basically cash transactions. The next step for them was to start to buy treasury bonds. They started to do that last week because treasuries were going down the same times as stocks were. That's not supposed to happen. So the bond market was broken. So the Fed stepped in and fixed that in a big way. Now this week, they've announced that they're going to be buying corporate bonds and high yield bonds and even municipal bonds, like state of Colorado municipal bonds. What that essentially means is a couple things. One, the Fed learned a lesson back in 2008. I remember reading it distinctly back in 2008 that people thought the massive influx of liquidity, trillions of dollars from the Fed, was going to cause hyperinflation, and we were going to be Weimar Germany in the 20s, and gold was going to be $5,000 an ounce. And none of that ever happened. And the reason it never happened is because the Fed parked all of those assets on their balance sheet and never forced it through the system. So I think the Fed's taking a page out of their own playbook, and basically they're going to be parking all these trillions of dollars on their balance sheet. To kind of get some context around that, the balance sheet maxed out at about $4.5 trillion back in 2014 before they started to let a lot of those bonds mature and let those assets kind of bleed back into the system over time. It's now expected that the balance sheet is going to double that size. So the max was 4.5 trillion 6 years ago. Now it's expected to go to 9 trillion over the next 12 months. This is unprecedented. It's an experiment, and there are risks involved with that. It worked out in 2008, and I think the assumption going forward right now is going to work out in 2020. We do have to kind of see how that plays out. So again, that's kind of the first leg of the stool. We have that, put the check mark next to that. Fiscal policy from the U.S. government, I'm being generous and putting a check mark next to that too. It's assuming that the bill that's in Congress right now will pass tomorrow morning. That seems to be the consensus. Senate passed it last night. Congress should pass it tomorrow, and the president should sign it sometime tomorrow or Saturday. Interesting thing about that, I put some statistics up on the screen here for that, but this is basically the gist of it. These numbers are obviously subject to change. These are the best estimates that we've got from what's in the package. The package is estimated to be $2 trillion. So from a financial standpoint, our deficit this year just went from 1 trillion to 3 trillion in a matter of days. There's all kinds of things we could talk about with that, but for the length of this call, we'll kind of park that to another time. But that's basically the gist of it. $250 billion in direct payments to individuals and families, nearly $500 billion for distressed companies, roughly $360 billion for small businesses, $130 billion for hospitals, and $150 billion for state and local governments. And most of that is going to be dedicated towards unemployment insurance support. These states are getting clobbered with insurance claims, unemployment insurance claims, and they need some fiscal support. So that's mainly the bill. There are going to be some direct payments to individuals that meet certain income thresholds. Again, the final analysis on that, we'll wait until they actually sign the bill, and I'm sure there's going to be some tweaks to that as we kind of go along here.
So Joe, obviously it's on everybody's mind. I mean, the major effect of what we're seeing right now is the virus. Mm-hmm. So, I think everybody's kind of become a virus expert, or at least they know one on social media, it seems like. So can you obviously trying to decipher the information right now, and getting a feel for the effect on that. Can you kind of speak to, just some of the numbers that we're seeing and overall kind of how our thesis is playing in with the virus?
Yeah, so unfortunately, there's not a whole lot of good news there yet. So I did put the red X next to that one. That is the third thing that we need to see. We need to see some containment of this. We would prefer to see a decrease in the number of new cases. Again, at least a deceleration of that. But in specific areas, namely New York, California, and now Louisiana, the cases continue to spike. Yesterday in the United States, we had 13,355 new cases. Day over day, that's a 24.3% increase. So unfortunately, we do not have this under control yet. Some of this is a function of testing. We are testing more, but I'll give my own anecdotal experience with this. We're only identifying the people that we test. And the example that I'll give, I know someone in Boulder. I went to high school with her, and I lost track of her back in 1990. And we actually met up here again because her family moved here 6 months before mine did. Her husband tested positive for coronavirus. They have a letter from the state of Colorado that they're under mandatory quarantine for 14 days, their entire family. She now has the symptoms of it. Their daughter has the symptoms of it, but they're not being tested. It's just assumed that they have it, but they're not counted in the official statistics. So there are some quirks with how we're counting people, and what we're finding is that all the countries that are reporting are counting people differently. So unfortunately, there's really no uniform standard yet, and there probably never will be as far as how people are being counted, how many are passing away from it versus how many have it versus how many confirmed cases we have. So that one little household in Boulder, there's one confirmed case and 2 probables, but the 2 probables don't get counted anywhere. So we do need to get that done. And unfortunately in New York, it just seems like it's getting worse and worse. The hospitals there are already short-staffed, short-supplied, and they're in great danger of being overwhelmed if they aren't already. There's a handful of hospitals that already are. There is a military hospital ship now parked in New York to take on cases, and the U.S. Army is currently repurposing the Javits Center into a 2,000-bed hospital as we speak. So unfortunately, in terms of containment of the virus, we have our own epicenters here. Everyone was referring to Wuhan as the epicenter for a long time. Now we have 3 of them. We have New York, California, which are very, very large economies. If they were standalone countries, they would be in the top 10. And now Louisiana, where it's just spreading like wildfire. So unfortunately, we don't have that, but we have the first 2 in terms of fiscal and monetary response. Now, how that plays into our current economic thesis. This is where it gets a little choppy, and this is where we just don't have a whole lot of visibility. So our current base case is that we expect unemployment is going to rise anywhere from 6.5 to 7.5 in the short term. That's roughly 5 to 6 million people. And when I say short term, unfortunately, I'm talking about weeks, not months. Today, we had the initial unemployment claims come in at 3.28 million. People need to understand how big of a number that is. For context, The largest number ever recorded was 695,000 back in 1982. Even during the financial crisis, the weekly high for initial unemployment claims was only 665,000 in March of 2009. So the 3.28 million number, I think people are numb to that, but just to put it in context, I can't even put words to how massive a number that is, and that probably isn't even the true number. There are reports nationwide of state unemployment systems crashing. Their websites are not functioning, so people can't get online and apply because there's simply too many people trying to apply. What we are concerned about mainly with unemployment claims is not the big number today, and even the market today seems to be shrugging that off a little bit. Some of this is going to be in terms of duration. 3.28 is a big number, but do we get that again next week? Do we get it the week after that? And then what does the week after that look like? So those are the big numbers that we have to kind of go forward with. Now, it's important to kind of couch this a little bit. So 3.28 million is a big number. It did end, we had 113 straight months of consecutive job growth coming into this. That was the largest ever by nearly 3 times. So the economy was healthy coming into this. And I don't think that the worst case scenarios here are going to be experienced. So the St. Louis Fed came out on Sunday. James Bullard is his name. He's the governor there. And he said that if the government didn't act swiftly, we were going to be looking at 30% unemployment and a 50% cut to GDP. Those numbers seem really high. And he was mainly saying that if the government did nothing, and we know that that's not the case. So I'm not so worried about that. I mean, the next big thing, as I have on the slide up here, is GDP, the gross domestic product of the United States. What does that look like? It's not going to be a 50% cut to GDP. The numbers are going to be ugly. There's no doubt about that. I think a week ago, even I was anticipating, and I think I mentioned it on the call, that the first quarter, we still anticipated it to be slightly positive, and I'm not sure about that anymore. We've gotten some new data in that looks like even the first quarter may be negative. The second quarter, everyone acknowledges that it's going to be ugly. But when you start to hear those numbers, there's some context that you need to know. Most of the numbers you're going to hear are going to be annualized. So when you hear 10%, 20%, 25%, those are going to be annualized numbers. In real terms, we're probably looking at an immediate 4 to 5% trim in GDP. But the news outlets, they tend to be a little sensational, so they're going to annualize those numbers. So they're going to put out those big numbers, and that's important to kind of make sure that we keep that in context. So what does this mean coming out of this? We essentially see 3 potential outcomes. The first one, and some of these you've heard, and one of them I made up for this call because I think it describes the situation appropriately. A V-shaped recovery. V-shaped recovery has been kind of put in the news a little bit. That's very much like 1982, where we had a very sudden spike in those unemployment claims. Again, I mentioned the sudden spike in 1982 that was the previous record in unemployment claims. That's probably not going to happen. There is simply just too much capital destruction going on right now with a complete shutdown of the economy to have a completely V-shaped recovery where we have a sudden pullback and then a sudden rally. Unfortunately, I just don't see that playing out here. The second option would be what I'm calling the Nike swoosh recovery, where it tapers down really fast and then you have a really slow uptick on the way back up. That's kind of what happened in 2008. We really never fully recovered from that until 2015-ish or so from an economic standpoint. So fortunately, I should say, that's not on the table either. What I really do believe is going to happen is more of a U-shaped recovery. And this is kind of what happened back in 2001. And many of you have heard me say that the next recession will look like that. And that's kind of what our anticipation is. So maybe not a multi-year recovery period like the Nike swoosh, not unfortunately a multi-month recovery. This is probably going to be 18 to 24 months before we recover from this. But as you mentioned, Andy, there's a lot of assumptions kind of baked in there in terms of the fiscal policy, how fast we get out of this, how fast we can control the virus spread, and is the fiscal stimulus enough? And unfortunately, we're not going to know that for a few more months. It just kind of goes back to that lack of visibility.
Okay. So Joe, kind of talk to, I mean, the market seemed to, word we use a lot is whipsaw. We're seeing, a day the other day that was up over 11%, days where the market's down 9%. So, what's your take right now on the overall market action?
Yeah. So much of it is really gonna depend on the coronavirus. And again, some of this I've already mentioned, so I'm just gonna kind of blow through this slide. We're back on, testing appears to be catching up. The worst case scenario does seem to be fading. I don't think we're going to have 1 or 2 million deaths in the United States. That was one of the initial assumptions. The social distancing does seem to be helping. But difficult choices lie ahead. And this is kind of where the market stuff starts to kind of come in here. Reopening of businesses may ignite a second wave of the virus, but delaying may cause more harm to the economy. So those are the choices that we're faced with. And it's interesting, everyone has an opinion on it, and sometimes they make very valid points in both directions. But unfortunately, when you actually visualize the data in the total number of cases, I was talking to an economist from a very large investment house, and hopefully everyone can see my mouse kind of circling here. He was saying that this was the end of the virus back in mid-February because cases had sort of flatlined. Well, obviously, we can see what's happened since then. It's just gone up exponentially in a matter of weeks. And unfortunately, the total number of deaths has done the same thing. So the market has been kind of whipsawed with this as well. And the quote that I heard the other day, I wanted to share with everybody, I thought was appropriate. Every day feels like 2 months in the stock market. We have seen days where we've seen the Dow move 3,000 points in a day, up and down, up and down. We've seen massive sell-offs. We've seen huge rallies. And this in our industry is what's called price discovery. And that's what the market is kind of going through now in a process is price discovery, where basically no one is really confident in what assets should be priced at. So that's why you see some stocks up 20 or 30% one day and down 15 or 20% the next. Because everyone is re-evaluating what stocks are worth. Sometimes they're causing valuation opportunities, and sometimes it's probably those companies aren't going to be around in another 6 months or so. And again, unfortunately, I can't mention any specific names on this call for compliance reasons, but I'm sure some of you know what I'm referring to there. Now, interestingly, on this chart, Tuesday was one of the biggest S&P 500 days in history. I know the Dow was kind of touted as the best day since 1933, but it's important to remember the Dow Jones is only 30 stocks. The S&P 500 is 505 technically. So one stock out of that Dow Jones can really move significantly. So yesterday it was Boeing. Boeing really spiked yesterday and helped lift the Dow. So we like to use the S&P 500. It's a much more broad-based measure. Now the interesting thing about this, the S&P 500 on Tuesday wasn't in the top 5 days of all time, but it was up there. But the thing is, when I look at this and I look at some of the other dates around this, that is not comforting. You look at 2008, specifically October 2008. You look at 1931, 33, 39, 1929. That does not make me feel warm and fuzzy. That happens to be one of the best days in there. Now, granted, it was a nice reprieve. It was a nice day. It made people feel a little bit better rather than going the other way. But unfortunately, it's not great company there in the 20s, 30s, and in 2008. And this recent rally that we've had here over the last 3 days, it isn't stunning but it is a surprise. And I think, we learned this back in 2008, where in the depths of the financial crisis, and Andy, I'll just ask you, did you know that in October of 2008, that there was nearly a 15% rally in the S&P 500 during that time?
I should say that I do know that, but no, I didn't.
Yeah, so it's interesting. From
Thanks, Joel.
You're welcome. Yeah, I like to throw Andy under the bus on these calls from time to time.
Why?
And most people don't. I mean, 99% of people don't. People in my industry don't. And I'll be honest, I didn't know until I went and looked back at the data.
Yeah.
I should have remembered that, but everything else that happened after that, I mean, I kind of blocked it out of my mind. Because it was a very small piece in a very bigger picture. But from October 24th, 2008 till November 4th, 2008, so literally just a 10-day period, the S&P rallied 14.7%. Now, from November 4th to November 20th, it dropped 25%. So what's the lesson there? The lesson there is that fiscal policy has its limits. So if you recall back in 2008, every politician was kind of patting themselves on the back that they were doing everything they could to save the economy and blah, blah, blah. And the market kind of participated with that a little bit for a while. And then it just sort of petered out again from November all the way down to March 2009. In addition to that 25% return, there was probably another good 10 to 15% on top of that that took another 3 months to really play out. So I'm not saying that that's the path we're going to take here. I'm not telling you today that there's another 40% downside from today, but what I'm saying is that we need to be extremely cautious with any sort of fiscal policy stimulus here and the market reaction to it. Unfortunately, we've seen this time and time again where the market gets a little bit of a sugar high and then economic reality sort of sets back in. Along those lines, so what are we looking at, right? What's important to us? What's the data we're looking at, and why is it important? First thing is going to be initial unemployment claims. Those come out every Thursday morning, like clockwork. What we're looking for there is obviously any uptick, or even more importantly, consistency in really high numbers. That would cause the market to sell off. I'm not sure that we're done yet. With having some big numbers on that. And fortunately, we get those every single Thursday. So that is relatively immediate data that we can actually act on. The next one is going to be the job openings and labor turnover survey. That's called the JOLTS report. That comes out on April 7th for February. So that data is not going to be as helpful. And May 15th will come out for March. That one's going to be huge. So what we've seen with that report over the last few years, it's been at record highs, and it's been at record highs for years. And what that tells us is how many jobs are available in the United States. And for years, we've actually had more jobs open than people looking for work. That number is going to change dramatically over the next 60 days. And unfortunately, that's going to be a little more delayed in getting to us. But it will give us an idea as far as what happened in the real economy now. The next one is the official unemployment report that comes out on the first Friday of each month. Retail sales is going to be critical, and that's going to be generally mid-month. Some interesting information for everyone listening. Everyone assumes that the retailers are doing a great job right now. If you try to go to Walmart, Target, Kroger, Safeway, King Soopers, any of those, the aisles are bare, right? So one would make the assumption that the retailers are just doing a great job right now. Unfortunately, to keep those aisles stocked, there's additional expense to them. So I was listening to an analyst the other day who said that in the past 30 days, it's estimated that Walmart has spent an additional $300 million that it had budgeted to get their product from warehouse to stores. So if you think about the additional truck traffic, the overtime that the drivers are paying, the overtime that you're paying the people to stock the shelves, because that's not all automated, it's actually costing them a lot of money. Now they're still making money, but it's not like it's a free ride. As the old saying goes, there is no free lunch. So these retailers are actually coming under some stress because they're tapping into credit lines to actually fill their stores. So they're making more money, but they're also spending some too. So that interesting little quirk there in retail sales, and that's generally mid-month, usually somewhere in the 15th to 17th. It varies from month to month. And finally, GDP. We get the estimate on GDP usually 1 month after quarter close. So April 29th and July 30th are 2 big days for that. So those are the data points that we're tracking. Now, in terms of trying to find a market bottom here, where is it? Was it Monday? It's very possible. And calling the market bottom, the problem with calling that is you never know where it is until it's too late. By definition, you don't know that there was a bottom in until the next trading day, right? So if the Dow Jones closed at 18,000 on Monday and then went to 19,000 on Tuesday, you didn't know that the bottom was in on Monday because it was already too late. So we're not trying to time bottoms here. And I bring up this chart from January 2009 to April 30th, 2009 to prove a point. And this is kind of morph into how we're going to be managing the portfolios. So here on January, this is basically mid-January, if you can see my mouse kind of circling here. Mid-January of 2009 would have been a fine entry point. Even in February 2000 would have been a fine entry point. Obviously, the best one was March 9th. But if you had just invested here in mid-January, yes, you would have seen some drawdown across there. But if I'm drawing my mouse straight across, you would have had all that back by late March. So we're not trying to time market bottoms here. What we're going to be doing is playing selective offense. And to us, it's going to be nearly the reverse of one of those slides I showed you a little while ago, how we sort of dollar cost averaged the portfolios to be more defensive. Now we're going to be doing it the other way around. So yesterday, in most portfolios, not all, but in most, we actually started to buy high yield bonds again, AKA junk bonds. The reason we did that is because of valuations. So the same reason we got out of them 2 years ago is the same reason we got into them now. Now, my predecessor here had bought high yield bonds for most of you the last time they sold off, back around 2015, 2016, and most of you had a very positive experience owning those bonds. I mean, when you buy them in the right place, there's a potential for them to give you stock-like returns. And they did that. So we made very small trades in most accounts. Again, we're going to be kind of easing ourselves back into that space. And eventually there will be a time to enter stocks again. We are not comfortable at the current levels just yet, but we are buying some of the distressed assets that honestly at this point, they're so cheap, I can't ignore them. So that's the key point I want to drive home here, is that it's not necessarily making sure that you buy at the bottom, because no one ever does, again, because you just don't know when that bottom is until it's too late. And certainly things that are cheap can get cheaper. But you want to buy asset classes that you want to hold for the long term when they are cheap. And yes, they may go down another 5% or so here, and then we would buy a little bit more, but the anticipation is over a 3 to 5 year period, they're going to treat you really, really well. So it's time to play selective offense, but still stay defensive until we have a little more visibility in terms of the economy. And that, unfortunately, we may not have for another 6 to 8 weeks. In the final analysis, there really is no perfect time to buy risk assets. But every now and then when those evaluation opportunities arise, you want to make sure that you take advantage of them and not try to time the bottom. And again, I use this example from 2009 as the key piece. If you had bought here in mid-January, yes, you were 2 months early prior to the bottom, but you weren't so far off that it devastated your portfolio. And that's probably where we are now. We're probably here in March of 2009, where there may be some more downside potential, but we think we're closer to the bottom than we were maybe a month ago. So it's time to start playing selective offense.
Can you, Joe, one of the things that we get a lot of questions about, I don't want to throw you off too much here, but when you're talking about the changes that we've made and what we've done, can you kind of talk a little bit about, I know we've mentioned the hedge position we put in the portfolios. Can you kind of speak to the hedge position, kind of how that operates, and maybe even some of the why we did what we did there.
Yeah, the hedge position is basically again, for lack of a better term, a bet against markets. It's not a one-to-one, it's close to it. And that's good for when markets rally like this and you own a hedge. You don't want to be one-to-one the other way either. But it's interesting. I actually had a conference call. It was just me and Cade and just with the PM yesterday. I can't tell you how rare that is to actually get the people that run the fund on the phone. Usually I get stuck on a sales desk or with someone trying to sell me something. But to actually talk to the PMs is extraordinarily rare. And I actually had a good half-hour conversation with them yesterday. The hedge that most people have in their portfolios is essentially they do own some long stocks in that portfolio, stocks that they really, really like, but they will use put options on the S&P 500 itself. And they'll actually even drill that down in individual sectors that they don't tend to like, and they'll sell put options on there. So for people unfamiliar with put options, that's basically you're buying a right to sell something at some point in the future. So for example, 3 months ago, they may have been buying puts on the Dow at 24,000. That means that they have the right to sell the Dow at 24,000 no matter where it is. So obviously, if the Dow's at 25,000, they're not going to do that. But if they can sell at 24,000 when the Dow's at 20,000, that's a good investment for them. So that's sort of what they do there. They will short individual stocks too, so basically bet against individual stocks. But more and more, what they do is basically take larger macro level bets against the direction of the stock market, and that worked out really, really well for us the first few weeks. Obviously, this week. It's not working as well, but it's more of a position for us where we anticipate a lot more volatility. In fact, PIMCO, I was on the phone with PIMCO this morning, and they were saying the same thing, that the volatility is not going away. So they anticipate more bad economic data and more volatility coming in. We will peel back from that position eventually. In fact, if we were to start to see markets deteriorate again, we would start to peel that position back and again, kind of dollar cost average back into stocks and even riskier bonds because those are starting to appear cheap. Stocks are still not cheap enough to really just dive in here. There are some selective individual names, but as far as going into a sector like large cap value or large cap growth, we still feel that there may be a little bit more pain there. At the end of the day, we have investments. Everyone is invested in stocks in their portfolios. We didn't go to cash, so there is some participation in the upside. The hedge, we feel is a prudent option at this time, given the uncertainty that we have. We don't know what second quarter GDP is going to look like. We don't know what the unemployment rate is going to look like. Everyone's giving their best guess. And there are some concerns there that it may actually be worse than what people are kind of letting on. So that's really what the hedge is designed for. That's why we have it in the portfolios. We weren't getting the pop out of bonds that we expected, and we kind of anticipated that. This is one of the reasons why we had the hedge is because interest rates can only go so far down. To give you some context, the last time we had a big economic pullback, 2008, the Fed funds rate was at 5%. Coming into this, we were at 1%. So when you cut from 5 to 0, that is a huge move. Cutting from 1 to 0, not so much. So we needed something in the portfolios to really protect to the downside because we didn't feel that bonds were going to deliver that, and certainly they haven't. In fact, even Treasury bonds, as I mentioned before, sold off a few weeks ago, about a week to 10 days ago. So the hedge has done its job in the portfolio, and we're happy that we have that there.
Okay. Joe, last piece today. And again, we've heard some feedback from a lot of you. We checked, and unfortunately, the issue is with Zoom. A lot of people are using Zoom right now for a lot of purposes. And so some of the audio quality issues, unfortunately, nothing on our end that we could fix. So appreciate your patience. For the recording, we'll probably re-record this so that way the audio quality is quite a bit better. So the last thing, we talk a lot about benchmarks, and I know, Ryan and Steph have explained why benchmarks are important inside the financial plan and kind of how we use those to measure ourselves as far as, the risk we're taking in portfolios, the return we're getting in portfolios. So can you kind of walk us through the benchmarks, how they're constructed, and really overall what they are?
Yeah, so basically the simplest term is a benchmark is how you compare yourself to something else. And there's a lot of different ways to do it. We have used JP Morgan and Ibbotson as kind of our guidelines in terms of how to construct benchmarks. So everyone on this call has a different risk tolerance and a different risk profile. Some of you are more growthy, some are more conservative, and some kind of fall somewhere in the middle that we call moderate. But there are some commonalities here on these slides. So we use the Russell indexes mainly. The great thing about Russell, as compared to some of the others, we get a little bit better of a look through there. So for example, if we were just to use the S&P 500, they charge about $30,000 a year to get access to their benchmark. Now, anybody can look up the performance of it, of course, but to get any other detail on it in terms of its construction, its constituents, that kind of stuff, I mean, you can kind of use a proxy with an exchange-traded fund or some sort of passive investment, but it's not going to be a one-to-one thing. Russell is much better with that. So we use Russell indexes. So Russell 1000 is kind of like the S&P 500. But they have the growth and value sections there. We also use the Russell mid caps. So those are a little bit smaller companies. The Russell 2000 is small companies. And then we have some international indexes in there as well. So this is basically your asset allocation sort of modeling on the equity side, on the stock side of the portfolio. So you have some large companies, some medium-sized companies, some small ones. And then, of course, you have your international with the EFI index, and then you have your emerging markets, and finally some real estate in there too. So it's a little bit of everything. It's a smorgasbord, if you will, of basically asset allocation. So we have that in there, and we use those in specific percentages, which I'll get to here in a minute as some examples. But we do the same thing on the bond side. So not all bonds are created equal. The big one is the Bloomberg Barclays Aggregate Bond Index that used to be Lehman Brothers way back in the day, the Lehman Ag. But we also use long-term bonds, short-term bonds, cash, and there's an emerging market bond component in there as well. So when JP Morgan and Ibbotson put these together, they were really a risk-weighted benchmark component. So it's a combination of generating enough return in your financial plan and making sure that we don't use too much risk in there as well. So how we use those in percentages, when we look at some of our, the way we manage money, there's several different ways. So for some of you, growth isn't enough. So we have what we call a tactical equity opportunity portfolio. So all those definitions that I had up there before are kind of broken down here. We have 1% in cash, and then roughly 45% in large stocks, all the way down to having 20% international, nearly 14% in emerging markets. And then we sort of start to ratchet those down. So as we kind of go into the growth, you can see the large caps here get significantly smaller, and the bond position gets significantly bigger. Overwhelmingly, I would say our moderate clients make up the bulk of our asset base here at Aspen. So this is what we call balanced with growth. I mean, those are our moderate clients. And you'll see here roughly 40% in bonds and cash. So that kind of goes back to the 60-40 portfolio that we often talk about. But the constituents stay the same. We just changed the numbers. So how we're managing things right now, we essentially go plus minus on a lot of these. So right now we're pretty minus on the bulk of this page right here in terms of stocks. For example, the Russell 2000, I mentioned the smalls before, smaller companies, they're roughly down 40–45% in this sell-off. So everyone talks about the Dow and the S&P 500 being off 20. Small caps are down double that. So we eliminated those probably a few weeks ago before the worst of this kind of started up. And again, it was a relatively small piece in the portfolio, for most folks. But we can also dive back into that. And in fact, that may be one of the first things we add back to if we see an attractive entry point for those because they're so cheap at this point. They may not be cheap enough. As I mentioned before, things that are cheap can get cheaper. And we'll see to reallocate those in the near future. And finally, for the conservative clients, the numbers in the fixed income space, the bond space, what people typically consider the safe space is up to about 55–60%.
So how often would you say, and I know we want to try to keep this to an hour today, but how often are we deviating from the benchmarks?
Mainly for the last 18 months heading into this, we were pretty much spot on with the benchmarks. Okay. We had the plethora of things that you see on the screen in front of you, and we were really, really close to those benchmark weights. I mentioned it early on in 2019 during that rally. We were trimming and making sure that we didn't stray too far from those allocations because the valuations just started to get a little high. So we will let things drift higher when markets are appropriate. When you're at the end of a business cycle like we were, and we've talked about this many times in terms of what marks the end of a business cycle and some of the red flags that pop up, you start to see credit card companies report increases in defaults, car loan companies report increases in defaults. We saw all that in the fourth quarter. So those were concerns to us. I mean, those aren't perfect indicators, but they're pretty good indicators of what's going on in the economy, which is why we were trimming those profits along the way. And I'm glad that we did, given obviously what's been going on here. And this is going to kind of go down in history as one of those things where no one saw this coming. You've heard me talk about the leading economic indicators a lot. I mentioned them on last week's call. The leading economic indicators as of today are still positive because we haven't had a new data release. We've never had a recession without those going negative first, and this is probably going to be the first time that that's ever happened. So it's one of those things where this is why you don't let portfolios drift way out of tolerance, because you just never know when one of these types of events are going to happen. And for the most part, I would say overwhelmingly so, that most of the clients, Andy, are performing far better than their benchmarks. Unfortunately, that doesn't mean that they're positive, but we are performing far better than their benchmarks. And in terms of what that means to the financial plan, it's far better to protect on the downside because we have more capital to deploy when markets turn around. If we pull back more than the benchmarks, that kind of goes back to the whole capital destruction sort of scenario where you have to be able to rebalance into these things, and you have to be able to take advantage when markets are low, and you have to have capital to be able to do that. So if you're too aggressive coming into this, it makes it harder to get out.
So I'll leave you all with a couple of just a couple of items today. And I, first off, I just want you to know how committed and dedicated our team continues to be. If you get a phone call to set up an appointment from Amber, more than likely you'll hear Colin cooing in the background. Joel's been here a lot of nights till 9 o'clock working on education. He and Kate have been participating on conference calls. The team stays very, very committed to all of you, and that means the world to me. I want to thank Joel and Cade because they have put a lot of research, a lot of effort into every investment decision that we're making right now. And I really feel like across the board they've really done an outstanding job, kind of helping protect to the downside. I also want to thank all of you. I want to thank you for your patience, your understanding. Obviously, this is something that probably none of us ever had on our radars of something that would be happening in our world. So certainly appreciate all of you. I want to leave you with one thing, and I talked to my team about this morning. There's a lot of negativity out there right now. There's a lot of bad news. There's no question. There's a lot of unknowns. There's a lot of people that are scared. There's a lot of fear. There's no question. But as I was thinking about it on my way in to the office this morning, what amazes me is that there's no question there will be businesses that will fail. Unfortunately, there's going to be times that we're going to drive by, empty retail space or maybe where a restaurant was at one point. But the thing that I think is so impressive is the resiliency and the creativity of small businesses. You've got companies that are doing very creative advertising and reaching out. You've got restaurants that, are doing everything they can to, number one, still provide meals for, the community, but also, keep their doors open and try to retain as much staff as possible. So, I leave you with that because, that's always been my faith in the U.S. economy is the creativity and the resilience of the American people. So I thank you all today. I'm sorry the quality of the audio wasn't what we would hope it would be. I hope the information was helpful. We'll certainly keep you all posted here in the meantime. Thank you all, and we appreciate you very much.